tax partnerships as well. And so let's go through the, uh, you know, so if you actually look at if there's a distribution of capital assets uh, on dissolution, until assessment year 87, 88, there was an express exemption provision under section 47, which exempted any transfer of business or assets given by a firm to a partner on dissolution. I mean, so any distribution of capital assets on dissolution was exempted. This was a provision until 87, 88. Supreme Court in the case of Bankelal Vedya, it specifically stated that when assets are distributed from the partnership firm to the partner, there is no taxation event because the partner already has a pre-existing right, and therefore what the partner gets is a mere share of his existing right, and therefore there is no transfer. Uh, in Finance Act 1987, from assessment year 88, 89, there was a provision which was introduced. So the exemption provision in 47.2 was deleted, and 45.4 was introduced along with 45.3. So on applicable on admission of partners, and 45.4 was applicable for retirement or dissolution or otherwise of partners. The taxation provision said that if there is any profits and gains arising from transfer of capital asset on dissolution or otherwise, then such profits and gains were chargeable in the hands of the firm in the year of transfer. So what these provisions had entailed is, first there should be a transfer, second there should be a distribution of capital asset, and third it should be either dissolution or otherwise. So these are the three terms which are critical: transfer, dissolution, distribution. There are judgments, Honorable High Court in case of Malabar Fisheries, and then in Mohan by Pamma had specifically reiterated the same judgment with the Honorable Supreme Court in Bankelal Vedya had told that when a partner receives asset from the partnership firm, he does not get any new right. It was a pre-existing right which he had in the partnership firm. Therefore, if there is any asset he receives from the firm as a satisfaction of his capital account, there cannot be a transfer. And this principle goes back to general law under the Partnership Act itself. Because the Partnership Act says the partner and the partnership firm are one and the same. So following the same principle, Supreme Courts have consistently held that there is no transfer at all. Interestingly, Honorable Bombay High Court in ANI case had told that no, after the deletion of provision 47.2, that deletion of 47.2 itself sufficed without a requirement of being called as a transfer in section 247. It was a sufficient charge to create a taxable event in the hands of the partnership firm. This judgment of Honorable High Court, Bombay High Court, was later on reversed, by a series of judgments by the Honorable Supreme Court. Now, to actually nail this issue, and recently in Madras High Court, we had National Company judgment, which specifically reaffirmed the same position that on retirement or on dissolution, there is no transfer from the partnership firm to the partner. So to tackle this issue, the Finance Bill proposes that notwithstanding anything contained in 45.1, the provisions of 45.1 requires that there should be a transfer, and there should be a transfer of a capital asset. So now the law says, notwithstanding anything contained in 45.1, if a partner receives any capital asset, so now we are moving the goalpost. What was the goalpost of transfer of capital asset? Because Supreme Court have told that it is such transfers are not transfers, they have now said if a person receives, the partner receives any asset from the partnership firm, either at the time of dissolution or reconstitution. The erstwhile regime specifically said dissolution or otherwise. There were judgments to say or otherwise cannot include retirement or can include retirement. Reconstitution was included, not included. So there were several debates and discussions going on whether these were included or not. So now the law specifically provides that if there is any receipt of capital, even on reconstitution, profits and gains arising from such receipts will be chargeable to tax, not in the hands of the public, but in the hands of the partnership firm. What's critical here, maybe one point of discussion will be, what is reconstitution? Reconstitution, if you look at provision section 187, change in the partners is treated as reconstitution. Admission of partner is a reconstitution. Retirement of a partner is reconstitution. Question arises whether a mere change in profit sharing ratio without admission or deletion of a partner, whether that will amount to reconstitution. And that is one point which we'll have to wait and watch whether this provision will attract a mere change in profit sharing ratio as well. A reasonable view will be actually to say even a change in profit sharing ratio should attract taxation, and the trigger of taxation is not a mere reconstitution. There should be a receipt of either capital asset or money or any other asset. So far so good. At least you would perhaps think that 45(4) was merely replacing the existing provision of 45(4) and a new provision to tackle the issues or the litigation in 45(4) were being addressed. In doing so, several Supreme Courts have told that when a partner retires and a payment is made over and above his capital account on account of goodwill, those goodwill is not to be taxed in the hands of the partner or in the hands of the partnership firm. So this was the position of taxation until now. The Honorable Karnataka High Court judgment, it's a full bench judgment, 3-member bench judgment, specifically had discussed in detail that again, when the money is received from a partnership firm by a partner from a partnership firm, it is only a settlement of accounts, there is no transfer, and therefore the provisions of 45(4) would not apply. This is in respect of money received. It is interesting to note if an inventory is given, even under the existing provisions, if a partner takes inventory at the time of either dissolution or retirement, the current provisions actually taxes the inventory, and such inventory is to be taxed at the net realizable value. ICDS provisions currently provides that if there is a dissolution of partnership firm, the inventory which is being transferred should be valued at net realizable value, not at cost or net realizable value, whichever is lower. Similarly, Honorable Supreme Court in case of ALA firm had specifically stated and brought a very nice distinction that they said when a business is transferred on going concern, you should only value the stock on cost or net realizable value, whichever is lower. But when the business is discontinued, that is when you actually cannot look at cost or market price, whichever is lower. You need to actually value the inventory on a net realizable value. Fair proposition. However, Honorable Supreme Court in Shakti Trading Company brought this distinction that if there is dissolution and discontinuation, ALA firm will apply. Inventory has to be taxed at fair market value. And if there is dissolution, but there is continuation of business, so I dissolve the firm, but the same business is continuing, you still have to value at cost or market price, whichever is lower. This is the current position. Now, from 2000, interestingly, it's a retrospective amendment, applies for all transactions from 1 April 2020. And therefore, if there are any retirement of partnerships which have happened from April 1, 20 till 31st March, the current provision says that notwithstanding anything contained in 45(1), therefore, without whether or not there is a transfer of capital asset, if there is a receipt of money or capital asset, then such receipt of money or capital asset should be taxed in the hands of the partnership firm. Now, Kishore sir was actually mentioning that we were deliberating as to why this taxation was brought in the hands of the partnership firm. Question arises, why is it taxed in the hands of partnership firm? When the income is received in the hands of the partner, why is the firm to be taxed? I think there's a reasonable rationale, and I think it's a well thought out provision. The reason I believe that it is right to tax in the hands of the partnership firm and not in the hands of partner is because of the introduction of the new provision under section 48, where they've said that in case taxation is, the firm is taxed to the extent of the excess of capital account which is given to a partner, that additional income which is already taxed will be allowed as deduction in the future whenever the firm sells the capital assets. We will go through this deduction by way of an example. Some interesting aspects of 45 and 45.4 and 45.4a you will not find in. I've seen that this analysis is not there anywhere, so it will be very interesting to see that the events which is taxing these 45.4, 45.4 is similar. It's a receipt of capital asset, but the language uses which represents the balance in the capital account. So 45.4 says when a partner receives a capital asset which represents the balance in capital account. 45.4a says only when you receive money over and above the balance in the capital account. What is the corollary here? If we let us say your capital account was 100 rupees and you receive only 80 rupees, that 20 rupees is not taxed, and therefore that loss is not available to the partnership. What is sought to be taxed is only profits, and the losses are not to be allowed. That's again a very interesting and important point to note. Second, you will also see that the deduction is to be allowed only in 45.4a. So only when you make payment over and above the capital account in form of money or other asset, that deduction is available under section 48. Only in section 45.4a, that deduction is not available in respect of receipt of capital asset by the partnership, by the partners under 45.4. That's another interesting discussion. And then we will also discuss as to why there is a specific proviso. If you look at the budget provisos, and I'm not sure if everyone's carrying the budget proposals. If you look at the taxation provisions, what is the tax charge on it? They say that if you receive a capital asset, take the fair market value of the asset which you have received. In a capital asset, they're saying reduce the cost of acquisition of that asset. So cost of acquisition of, let's say there's a land in the partnership firm, they're saying reduce the cost of acquisition of the land as per the computation mechanisms provided in the capital gains chapter. Now in section 45.4a, they say if you have received 1 crore and if your capital account is only 40 lakh rupees, the cost of acquisition will be the balance in the capital account. So if you receive 1 crore, your cost of your capital account balance is 40 lakhs. Only 60 lakh rupees is to be taxed under the provisions of the 45.4a.
You sign the
We'll come to the issues after we discuss a couple of examples. So let us take this example, and I would actually urge you to participate in this example, because if you could go through 2 examples, all the issues in section 45 and 45.4a will be very clear. Let us assume that there is a partnership firm of A and B. Each of them have invested 1 crore and purchased land for 2 crores. This firm is created on 1/4/2019, and in less than 2 years, the partners decide to dissolve the firm. And the terms of dissolution are like this. A will receive 4 crores in cash, and B will infuse 4 crores cash such that the partner A can receive that 4 crores cash, and the land will be given to partner B. So essentially, if you look at the the way the accounts are drawn up, the partners have decided that the fair market value of the land is approximately 8 crores. So 4 crores is the value which the partner B says I will take cash. 8 crores is the value which is to be given to partner B. Question is, what will be the taxation? I would like you to all participate and actually come back and say, what do you think will be the income which will be chargeable in the hands of the partnership firm? I have given the date 31/3/2021 because you all will be aware that this taxation is applicable even for the current year. So if someone wants to share their views, I'll be happy to hear.
3 crores.
Okay, so so yes, if someone can actually share, it'll actually tinkle the views and.
Market value is 8 crores.
Market value, stamp duty value is only 5 crores. The settlement value is 8 crores. What we two partners decided, Gautamji and I have decided, okay, the value is 8 crores. Gautamji will take 4 crores. I will take the value of the land with me. Since there is no cash, I will have to bring in 4 crores of cash contribution, which you can withdraw. Therefore, what will be the tax which will be payable by the partnership?
1 crore only, 1 crore. 5 stamp duty will go, 2 crores is original cost, 7 minus 8, 1 crore will be taxable.
1 crore is one answer which we have.
3 crores.
For the taxation,
Second answer is 3 crores.
there are two aspects here. One is the receipt of cash by A.
Yes.
So 4 minus 1, 3 crores.
Yes.
That is one taxation.
Correct.
Second taxation for B.
Yes.
The value of land is 5 crores minus cost 1 crore. Cost in the sense the capital balance. So 4 crores. 4 plus 3, 7 crores.
So we have three answers now. We have 1 crore, we have 3 crores, we have 7 crores.
What happens to the 3 crores cost? The 3 crores which is paid is cost.
We have 3 answers. Any more answers?
You'll get multiple answers.
If Gautamji's answer is accepted, I'm telling you, department will, all years of department will be open because they want to know how that 1 crore can be achieved. 6 crores is the fourth answer we have. Any explanation why 6 crores?
6 crores is because the value of property is 8 crores. Okay.
The stamp duty value is only 5, but you have taken the
Fair
value.
market value, because fair market value defines, under section 2 it is defined as the open market value.
Okay.
So I will take 8 crores.
Mhm.
8 crores minus 2 crores. So for land, the taxation, the gross value is 6 crores, but the capital account of A would have increased to 5. So 6 minus 5, it is 3 crores on account of the land. And or for B, 4 minus 1, it will be 3. So 3 plus 3, 6.
No. B is infusing capital to pay to A.
Yes.
So A, his capital is 1 crore already.
Yes.
He is receiving 3 crore more.
Yes.
So 3 crore will be profit. B
Correct.
is infusing to give to that fellow.
Correct.
So B already is invested 1 crore.
Plus 4 crores.
4
So
crores.
total 5 crores is the
Correct.
investment of B. Correct.
So he is getting the land by paying more 3 crores.
Yes.
So overall profit should be 3 crores.
So he is reasoned out very well. What he says is that, look, A has received 3 crores extra, so that has to be taxed. What he says, and I'll not give the answer. What he now says, I'm just trying to ensure that it is understood by everyone. Since B has contributed earlier 1 crore, now he's already additionally contributed 4 crores. So his contribution value is 5. Stamp duty value of what property is received is only 5. Therefore, there should not be any taxation for the transaction of B. For the transaction of A is 3 crores. This is what is the view of our friend colleague there. Any other view?
Even otherwise also it will be only 3 crores because 4 minus 1, 3 is taxed at the 45A, 4A, and the balance has to be taxed at the 45.4. When you are coming at the 45.4, it is the total value minus what is the capital minus only what is taxed.
Now, that's a good point. Now that is the interesting point which he brings. So what he says, taxation in the hands of A continues to be at 3 crores. So I think there is no debate in this room that the minimum tax value which the firm has to pay is at least 3 crores, because first A receives 4 crores, he has only contributed 1, therefore 45.4A is triggered. In 45.4A, the partner contributed 1, received 4, and therefore 3 crores is the income. I will add only one twist to this, only one twist. Gautamji's view could still come out, and it's a debatable issue. Even I don't have an answer. Question is, should we look at this transaction only for each partner now, or in a dissolution, should I look for all partners in aggregate? Question open-ended. I will leave it as it is. A reasonable view is that it should be looked for each partner separately. Okay, it should not be combined. But you never know how the dictionaries and the interpretation will go down. So that's the first aspect. Now coming to the second aspect of taxation of B, this is the most trickiest part, and there are no clear answers. So the first view is if you look at section 45(4), which is the receipt of the capital asset, the taxation provision says that if B has received the value of 5 crores, I am not taking the value of 8 crores. That 8 crores is the settlement between my internal understanding between me and my partner. I am assuming for all purposes I will be able to say the maximum value which should be taxed will be the stamp duty value. So 5 crores is the value which is the value of the land which the partner B has received. The law says the cost of indexation is not the capital account. The cost of acquisition of that asset is the cost which was acquired by the firm. So the cost of the firm is only 2 crores. So 5 minus 2, 3 crores is the actual income which is taxable in the hands of the firm. So in computation provision, first we compute what is the full value of consideration. Law says full value of consideration is 5 crores minus cost they say is 2 crores. A new provision is introduced, which is what Uttamji was sharing, that it says that to the extent that its tax is already suffered, then such tax already suffered should be allowed as deduction. But one issue which I will actually show it in the finance bill, the issue is the section 48 is applicable only when there is a transfer of capital. In this transaction, there is no transfer of capital assets, and therefore it is arguable that in such transactions this deduction will not be available. So it is an issue that on both transactions 3 plus 3, 6 crores will be taxed, and unfortunate part, they have said we will allow the deduction. But you see, after dissolution, who will take that deduction in that entity? Entity will no longer exist. So how will I actually take a deduction in that account? So the only other alternative which I have is to actually take a view that these kind of transfers are also transfers for the purpose of 48. And question is, then should I then be given a deduction of 3 crores? And with respect to partner B, taxation should be 0. That's the question. That's view number 1. Interestingly, law does not say whether taxation of 45(4) and 45(4)(a) are mutually exclusive or both taxation will apply. So this is one thing which is again not clear, and therefore the tax authorities could say both the transactions could apply. However, thankfully in this example which we have taken, partner B does not receive money or other asset, and therefore we can say that since he has not received any other asset, 45(4)(a) should not apply. Another question which arises, other asset, does it include capital asset? If other asset includes capital asset, even 45(4)(a) will apply. And if that applies, then again in our example, good part is the partner B has contributed 5 crores, he has received the value of 5 crores. Therefore, there is no taxation. So there are a lot of interpretation issues as to what is the meaning of other asset. Second issue is whether both 45(4) and 45(4)(a) can apply. And third, which of the views is right? Whether and both transactions should be included or not, should not be included.
Just to add that, other asset, capital balance is not an asset. Capital balance is a liability as far as partner is concerned.
No,
partnership firm is
so let me correct you there. The law says the receipt should be other asset. not what I give. So what I leave is the capital account. On the receiving side, what partner B receives, what partner A receives, he receives money. Partner B receives land. Land is other asset. If let us say you say that other asset includes capital asset, then partner B is receives other asset. So question is whether asset includes other asset includes capital asset. Does it include other asset? That's an open-ended question. That's the clarification they will have to give. Second issue, we have taken a simpliciter example, no indexation. We've taken an example only 2 years, less than 2 years, no indexation. Will indexation be available? Now indexation will it be available in both the cases? You see, when there is a transfer of land, in fact, I should not use the word transfer of land, when there is a receipt of land. That receipt of land, since again there is no transfer, but arguably the holding period should be taken into account. But when you receive money, how can there be a holding period for money? How could you actually compute a short term or long term there? There is no possibility of computing short term, long term. And to the if you people are carrying the Income Tax Act, it is very interesting to note. You should look at 45(1)(a). This is not a new provision. Section 45(1)(a) has similar provisions in an insurance claim. Again, similar provisions are applicable. No short term, no long term. They have clearly used similar thresholds just to draw a parallel. Now let us complicate and to have a better clarity of this issue. Let us complicate this example by making one twist. Same facts A and B with the good.
See, before A retiring, can firm itself revalue the land, bring 3 crores as a profit, so land value becomes 5 crores.
So our government is 2 steps ahead of our chartered accountants. They have specifically said while computing the capital account, revaluation of all assets, revaluation of self-generated goodwill, and they also knew that he will bring up with some other coinage of terms. So they said revaluation of any other self-generated asset, that also will be excluded. So any revaluation, any and all revaluation will be excluded in the computation. That is clearly tackled here. The second, the example, same facts of the case, 1 crore invested. Now we have, Gautamji and Ajit are partners. Kishorji and TRS say, no, we will now come into this partnership where we like this land. Therefore, Kishorji contributes 6 crores in cash and TRS contributes 2 crores by way of residential flat. Okay. And after that admission, A continues to get 4 crores. So that example does not change. Instead of me receiving, land, I have agreed that I will not bring in cash. I do not have cash with me. So I will rather take 2 crores cash and the residential flat which was contributed by TRC person, I will take up this 2 crores of residential flat with me. Now we have all agreed that taxation of 3 crores is there. Now question arises, what will be the taxation with respect of this 4 crores of receipts of partner B? Very interesting question. Very, very interesting. If you are able to crack this one part of this question, I think you will be able to reasonably crack all the issues under 45(4) and 45(4). Again, I invite what will be the taxation of in the hands of the firm with respect to transaction. Capital account is only 1 crore. B has only 1 crore capital. He now receives 2 crores cash and 2 crores by way of a residential.
3 crores. 1 crore on account of cash and 2 crore on account of cash.
So we have one answer which is 3 crores.
Cost of acquisition of 2 crores is not available. There is a flat.
We have one answer, yes.
Not bought by in-laws, bought by the partner. So it doesn't
For this purpose, it should be treated as asset of the firm because it is contributed by TRS, let us say 1 day before. So in this example, just to have more clarity, let us assume C and D are admitted 1 day before, and A and B retire on 31st, so that there is more clarity. Because on admission, I think there's fair clarity that whatever amount recorded in the books of accounts will be treated as the what you say is right. So I'll tell you what is the issue in the current law. The current law does not provide, section 55 does not provide that whenever there is introduction of capital under 45(3), the cost of acquisition should be that value which is recorded in the books of accounts. That law does not exist. It is an interpretation, and therefore I wanted to cover that part also. Thanks for bringing it up. You are right that the cost of acquisition is not provided in the law. But still we will move forward with that. That is not the issue we are focusing on. We are focusing on what is the taxation in the hands of firm with respect to the exit only. We have one answer of 3 crores. I still feel there are better answers. So let me help you with one thing. I'll just show you the provisions of the act so that you can, if you want, you can actually spend this time. So this is the provision of the act. I'll just, watch it. So notwithstanding anything contained in 1, where partner B receives capital asset 2 crores at the time of dissolution, answered, which represents the balance in his capital account. His balance in the capital account is 1 crore. That 2 crores is forming part of that 1 crore. Then any profits and gains arising from such receipt of the flat by the partner shall be taxed to income tax in the hands of the partnership firm. You see the computation mechanism. Fair market value of the capital asset, 2 crores. That will be treated as value of the consideration. Now see what is the cost of acquisition. The cost of acquisition of this capital asset, flat, will be determined in accordance with the provisions of this chapter, which is what? 2 crores. Okay. So the taxation with respect to that 2 crore receipt will be 0. Okay. And now look at 45(4)(a). It says where person B receives during the previous year any money, which he receives 2 crores again, at the time of dissolution, is it in excess of the balance in the capital account? Answer is yes. My capital balance is only 1 crore. So another 2 minus 1 crore is the receipt. So the computation mechanism says value of money 2 crores is the sale consideration. Balance in the capital account is 1 crore is the cost of acquisition. So in this case, 2 minus 1, 2 minus 2, 0 in respect of the residential flat which I get, and 2 minus 1, only 1 crore, not 3 crores, 1 crore is the amount. I still feel you could achieve the same answer which Pradeep gave, and it's an issue which is open to interpretation. If the tax authorities say that no, other asset includes capital asset, therefore what B received is money of 2 crores, other asset of 2 crores, so it's 4 crores, and therefore what is the value received is 4 crores, and the cost capital balance is 1 crore, tax will be at 3 crores. So this is the dicey subject, whether when you get both.
And we can always say that 4 should not apply. Well, you cannot apply 4 and 4A together.
No.
Well, I had a very interesting discussion with one of the lawyers today.
If it was inventory, then it come under 4.
No. So if we are assuming in this example that land is a capital asset. Let us assume that it is not inventory. Interesting point which we were debating is to say, look, if they wanted these two provisions to be a combined provision, it was not at all difficult. If you actually see the the verbiage of the language of the provisions, it's almost the same. They could have very well said, notwithstanding anything contained, where a specified person received during the previous year any capital asset, money, or any other asset, and they would have followed all this, and they would have said value of money or capital asset or fair market value will be being as fair market value. In cost of acquisition, they could have said cost of acquisition for capital asset is in accordance with the chapter. Cost of other balance will be in this. If they had combined the provisions, could that be a different meaning? And now that they have split the transaction, does it mean there are two transactions? Very interesting provision, very interesting interpretation, all open to discussion. We don't know how this will land into. Again, if someone were to look at a very fair view from a from a commercial angle, we all agreed that the total settlement value in this case was 8 crores, and therefore 6 crores should be the total taxable event. This 6 crores, however, should be allowed as a deduction in the hands of the partnership firm. So if the deduction is allowed in the hands of a partnership firm, then it is only a preponement. Otherwise, how this computation has to be done is a critical, is a debatable issue.
In hands of B, section 56 will also be applicable because it is without consideration.
56-10 should not apply in any of this transaction. So I am of the view that 56-10 will not apply.
Receive is not.
Given by the firm who be in the hands of
No, but why you say it's without consideration?
Exactly. The issue is the consideration.
Why you say without consideration?
the reason why I say without consideration, there is a shortfall of consideration. 2 crores of capital with 1 crore of capital, he's getting a set off by way of a cash transaction. With the 2 crores of land which is being received, that would obviously be charged as section 56-10.
So I'll answer that question. In section 56, if you look at it, the what is charged to tax is only property. Okay, property means it should be a capital asset. Therefore, in this entire example which we took, there are only in the first example the receipt of land, which is at 5 crores, that could be taxed. That is one event of taxation. And B, in respect of the second example which we took, there is a settlement of 2 crores residential tax. Now, question is, did I actually make the payment or not? Since the consideration is a settlement of a partnership firm, that is an asset which already belonged to me. You see, for me to have a receipt, I should have an effective receipt from someone. This is a pre-existing right. I would again go back to the same argument that there is not an effective receipt. That is argument number 1. Argument number 2 is consideration. I have paid effective consideration. If you look at section 45, that has already brought up a taxing provision. See again the language of section 45. Whose income is this? This is not the income of the partnership firm. See the language. This is the income of the partner itself. And then you see the language. It says, notwithstanding anything contained, where a partner receives any money or other asset, including the capital asset, which is in excess of the balance, profits and gains from receipt of such money by the partner shall be chargeable to income tax. Now, so what is the charge is the receipt. The same receipt is already charged. That income is that of the partner, but it is deemed to be. You also see the language, and shall be deemed to be the income of the specified entity. So this is actually the income of the partner, but it is deemed to be the income of the partnership firm. Since this income of the partner is already taxed, and the consideration, the differential consideration already taxed under this head, they cannot be dual taxation. That view can be taken reasonably safe. You can. I don't see challenge.
What will be the cost for B?
In respect of example 1,
In respect of extension,
2 crores. 2 crores in respect of.
but the partnership firm has never paid the tax because you said that fair market value is 2 crores. That's cost as per books.
So that the contribution also at 2 crores. No? So when T.R. Srinivasan contributed that property, he recorded that property at 2 crores. So he has paid the tax on 2 crores. That is the same property which has come to me. So tax has been that property has already been taxed at 2 crores. So here are the interpretation issues. These are the challenges. First question, does the capital account includes current account? I think it's a reasonable answer to say yes, it includes loan account not to be included. Does other assets includes capital asset? I've shown you examples. How does the taxation change if the capital includes other asset or not? To wait and watch and let's see how it is. Whether it is short term or capital long term. And that's where I was saying that, for 45-4, yes, there will be a long term or short term. But for 45-4A, perhaps no, there's no requirement to actually say whether it's a long term or short term. Whether indexation benefit will be available for 45-4, yes. 4A, perhaps no. What happens in the removal of gross block, whether there will be a dual dip? A very interesting point. Let us say this was a depreciable asset. Let's say the partnership firm had a, windmill. It claimed 40% depreciation. It's a depreciable asset. It is forming part of a gross block. And in that gross block, there are multiple windmills. There are 4 windmills. Now, one windmill has to be removed alone. Only one partner is exiting, and he only takes one. How will it be removed from the gross block? How will it be removed from the building? Whether there will be a removal of the cost of acquisition. If there's a dissolution, no issue. Let's say if there's a mere reconstitution, partner A retires, and he takes the value of the windmill, and let's say there's a fair market value of the windmill is 1 crore. Whether that 1 crore should be reduced from the it's an open-ended question. My view is it should be reduced. You cannot get dual deduction. So that's the view which I take. FMV is not defined. Another 2-3 interesting aspects again. The fair market value is actually not defined. 50D will not apply. In my view, 50D will not apply to this provision because section 50D says where there's a transfer of capital, where consideration accruing or arising as a result of transfer of capital asset. Here the consideration is on receipt of the capital. Now, if we take this argument, there is one policy, one major policy. If you look at section 47, exemptions are provided. It says nothing contained in this section shall apply to the following transfers. Here there is a receipt. So, question is when there is succession of the firm by a company, and if this provision is triggered for some reason, whether 47 exemption provision will be applicable in the first place. A very, very $1 million question. Perhaps it will not be available, and we only again have to go back to our expert judgment and say there is no transfer. Otherwise, we might not get that exemption. Very interesting conundrum which will be going. We've spent fairly good time just on one aspect of 45, and I have not covered even one small portion. There are too many issues to discuss. Go ahead, we'll take up the Q&A now.
Death of the partner.
Yeah. Interesting question. View can be taken that on death of the partner, if there is no dissolution. So, if let's say there are only the partnership deed provides that there will not be any dissolution of the debt, view can be taken that it is not reconstitution. That's my view. Wait and watch. My view is that no, it will not be a. And even let's say on the death, that partner actually exits. Let's say the partnership firm is that of 3 partners, and only one partner takes. It's an interesting view, but a view can be taken. I'll give you a hint. It is there in section 187. 187. I'll just read it out for you. It actually covers and defines reconstitution. In reconstitution, it says, provided nothing in clause A shall apply to a case where the firm is dissolved on death of any of its partners. So it covers dissolution on account of death. So perhaps we can take a few. So let me correct. If there is a continuation of the same partner on account of death, argument could be that no, the firm continues. If that partner exits, perhaps then there is a receipt. So I need to correct.
In that case, the profit sharing ratio will differ. 25%.
So that's why I'm saying if he's exiting,
Four partners are there. One partner died. So partnership was 25%, 20% equal partners. Now, due to this death, the partnership becomes 33% each.
So that means there is an exit of the partner. The partnership deed does not provide that his legal heirs will step in.
No.
So then in that case, I am telling that in that case there will be taxation under 45(4) and 45(4). Now, if the same deed provides that no, the deed will continue on death, his legal heir will step in. argument can be it is not a reconstitution. So then dissolution we also discussed about 48, that whether we will lose that benefit. It's a $1 million question. So ideally the department or the clarification should specifically say on dissolution how that benefit of 48 will be. Yes.
What about if the dissolution happens before 29 January, assets are transferred before 29 January?
Yeah, so it's a very good question. The provision as it stands now says that this provision will apply only if the assets are transferred at the time of dissolution or reconstitution. Let us say that there are events prior to or post the dissolution. Arguably, one view can be taken that these are independent transactions. 45(1) will trigger in that situation, not 45. So let us say if I transfer a capital asset to a partner, not on account of dissolution or retirement or reconstitution, I will argue that then it is a transfer and to be charged under 45(1) because it is not on account of settlement of his partners. So it's a proper sale, sale or exchange as the case may be. If an inventory is transferred from the firm to the partner, ICDS kicks in. ICDS specifically says those all inventory has to be taxed. So I think those provisions should be open-ended. We don't know whether these are tax planning areas. Some people are saying that since only taxation arises only at the time of reconstitution, it should not. I somehow feel it's a risky purpose.
Case law.
And now the issue is not only case law, they come with penalty. 270 penalty is automatic.
Any of 68 judgments of 68 will come with it.
Sure. Now we are already almost 1 hour into the discussion. I have 3 other topics: 148 corpus donations and the assessment procedures, etc. So I would like to actually get the feedback. Do we actually take this up after the GST event? Do we, President sir, what is your view?
Continue with it.
Okay, I'll take it up very quick. Corpus donations, we all know corpus donations are all exempt, no taxation. The amendment which is applicable from the next assessment year, it is not applicable from the current assessment, it's applicable from 1/4/2021. It says all corpus donations will be exempt only if they are invested or deposited in mode specified in 11.5. So if they are not invested or deposited in 11.5, corpus donations will be taxable. So let us say on 31st March, Tirupati, somebody were to go and the entire collections of Tirupati Balaji is all lying in corpus in cash. That cash is not in mode specified in 11.5, and therefore question and perhaps the taxation provision says those provisions will be taxable. In my view, the way the language is drafted, they have not provided for any accumulations. They have not provided any provisions to accumulate such, provisions. If it's a revenue received, they say that if you have not received that income or for any other reason, you can defer it for 1 year. This provision is not applicable for corpus. So essentially, you just do not have an option. The other interesting provision which is critical, it says that the corpus donation should be invested or deposited in mode specified in 11.5, which is maintained specifically for this purpose. So there is a word which I'm underlining, maintained specifically, which means that before 31st March of this year, you all have to advise all clients to actually have 2 bank accounts, 2 books, one for corpus and one for non-corpus. And it also means now you cannot do a backdated planning. The moment the money gets into a corpus account, they also say that if the corpus account is actually spent for revenue purposes, that will not be treated as application. So if money is transferred from corpus to revenue account, let us assume that's a school. Schools may, the biggest challenge in schools is the cash flow is very erratic. You have a fee collection in June, you do not have a fee collection for 3 months. So you have a corpus account, you transfer the funds. That transfer of the funds will not be treated as an application. and therefore unfortunate. And perhaps this will also be argued that they are not, invested in mode specified in 11.5. So two things will happen: it will be treated as income as well, and it will not be treated as application. So unfortunate provision, but this is the current provisions as it is. Another, I do not have the time, but I will urge everyone to read section 12.1 and read that with section explanation 1 to 11.1a. And the conundrum there is, if you actually look at any charitable organization, they are supposed to only spend 85% of the gross. Now, this provision says, if the corpus is not in mode specified 11.1a, it will be income, fair enough. That is income, admitted income. But then, now do I have to spend 85% of it, or do I have to spend 100% of it? A plain reading to me says 85% benefit will not be available. So that corpus money which is not deposited in 11.5, 100% of it has to be applied. Question again is, even if it is 100% is applied, will the deduction be available? Question mark. So these are the two challenges, which we all will be facing. It requires separate bank schools. We've discussed that bit. Loan and borrowing, fairly clear law that if you borrow and repay existing borrowing, it should not be treated as application. Our courts have held that it is application. Now they have specifically stated that it will not be in application. I feel it's a right, amendment in the right direction. Second issue is courts have said that if there is excess application, I have borrowed in the last year, I have done an excess application the previous year. Subros Education Society, Honorable Supreme Court has said that excess application in the previous year should be treated as an application. Now they have specifically amended the provisions to say it will not be treated as an application. So it's again a retrospective amendment, and because wherever I have applied in the past, that will not be able. Goodwill, much has been discussed in the newspapers on goodwill. I'll just touch upon two critical aspects of goodwill. Goodwill was created, generally created in two transactions. Transaction in case of slum sale, transaction in respect of mergers. What they wanted to actually snap and get hold of is transaction in relation to mergers. But then what damage they have done is a transaction relating to slum sale as well. The goodwill which was hitherto, which was allowable, depreciation was allowable on goodwill, will not be available. That's a major transaction for all slum sale. So any planning which we all do for moving businesses, etc., that will be hampered. It also, the retrospectivity in this is, they also say, to the extent that I have allowed till 31/3/2020, it's all fine. Whatever is the WDV line as of 2020, that will not be available. So assessment procedures, very quickly on assessment procedures. We all know section 1. Yes, sir. I'm not able to.
Not mind, we will have a break for 10 minutes. If that can be take Q&A. Sorry, sir.
Okay.
We finish this, we'll have small.
So 148, they have provided 6 steps, before an order under 148 is to be passed. There is a difference between reassessment, survey, and search, but there's also a combination. The current provisions, section 147, 148, 149, 150, 151, these are the set of provisions which provides for reassessments. 153A, B, C, D provides for search and requisition cases. 133A provides for survey cases. This is the broad scheme of the regulations. Now what they have said, they have merged all of the provisions. 133A, 153A, B, C, D have died. There are no more separate assessments for search, non-search. All will be bunched into one category. Now they have said that there are 2 types of no more reason to believe. Forget all the litigation on reason to believe. There's no need for them to have any reason to believe. They are only saying we have duty, we have information. That information will come from two sources. One is a red flag, whether it's a red flag, white flag, blue flag, whatever flag. one flag will be raised by CBDT as on a risk, management strategy. What is that risk management strategy? Nobody knows. So I don't want to make that up. So, and then second information is if there's a final objection by CAG, whether you like it or not, they're saying there's an information suggesting that income escape assessment. Two sources. In these two cases, they are saying reassessment can be done. Three things in such cases, they are saying that first, inquiry can be conducted by the AO. Reasonable view is that he cannot do a fishing and roving inquiry. A view can be taken that even prior to conducting that inquiry, and this is again where all the charge approvals come in, you need to ask this assessing officer, please provide what is that information or which risk management strategy which you are adopting in my case, and what is the objection from CAG in my case. He has to provide you that information, and after providing that information, he can conduct an inquiry. Whether that inquiry can be a mere physical inquiry, he can use 133A. Again, nobody knows. So that's the process he will have to follow. He'll have to conduct an inquiry with approval of the specified authority, which is CC, Principal CC, Commissioner, Chief Commissioner, Principal Chief Commissioner, and all the four brackets: CCIT, CIT, PCIT, PCCIT. Once he issues the notice and conducts the inquiry, he will provide us time between 7 and 30 days to respond to that show cause notice. Once you respond to that show cause notice, we will consider that and then pass and decide whether it's a fit case for reassessment or not. And once he decides whether it's a fit case, notice under section 148. This is the new process for reassessment. In case of survey also, and this is important, even in case of survey, the same process has to be followed. Only in the case of search, he is not required to follow this process. In case of search, in case of survey, it is deemed that if the survey is conducted, it is deemed that there is information suggesting that income is escape assessment, and he will have to follow this process. Assessment procedures, we all know about the timelines. I will not, deliberate on this. TDS, TCS, I think most of you are aware. We'll perhaps take it up in the Q&A session. Thank you, everyone.
Friends, we are going to have a small break, but you have to sit here. Some snacks will be served here inside the hall. In the meantime, subject to convenience of the speaker, we can take Q&A so that both can go hand on hand. So only for 5 to 7 minutes, then the other side will take over. Ramchandran sir, you had some queries. Oh, yeah, please.
We need to invest in unified board. Deposit in UP and take a loan against it. I understand we have to. I cannot use that as a completely under the detail, but at least I can overcome the.
It can be done.
Because if you look at people easy and all, bonds cannot be even spread.
Yes. Yes, sir. No issue. It can be. The reason why there is no issue, if you see, that is a borrowing of the bank, from the bank, in the revenue P&L, in the receipts and payments of the revenue account, that will show source of funds as receipt from loan of bank. That receipt will not be income. That loan will not be treated as application. So you are only going to perhaps pay that 1% additional. I don't think there's, the interest cost will be higher. I don't think that's close to liquidity problem. No, even liquidity problem, they are saying that you can transfer that money and you can replenish that account before, and you will get the deduction. So let us say there's a liquidity problem. You can transfer from the capital account to a revenue account, and just loosely using the word corpus, and this one is capital revenue. You can transfer that money. So long as you redeploy that money again from the revenue to purpose, that is something which they still is okay.
The problem is when you say the repayment of loan is not an application.
Yes, that will be an issue. That is an issue.
Until the final loan. If you're taking a loan for repaying
See,
the
same problem I'm saying. I don't have a FD to take a loan. And I want some money. I'm running a school. So I borrow at that time. And then I say that after that you repay the loan, there's no application.
So they are saying it will be treated as application if it is repaid from the income of that year. What they are saying is if two things they have blocked. If you have borrowed for the purpose of repayment of loan, not an application. If there is an excess application of the previous, that's not an application. Repayment of loan from the current year income, it's an application.
Maybe 5 years. ना मैंने तो नाश्ता कराया था
बहुत सारे transaction. But I think it's good because past transaction is there. One you can be taken because पहले वो discussion हुआ whether we should
So respected office bearers of the association, respected senior members who are present here. So, very good evening to all. So it was a very nice talk by my friend. Very technical one. There's always a difference between income tax and indirect tax, so to say. So income tax is highly conceptual. We get into the words, etc. Indirect tax is more of impact. Day-to-day impact is more. I mean, we discuss income tax one day, but somewhere, some situation we apply. Indirect tax daily we apply. Day-to-day impact is there, but conceptuality-wise, it is a little bit lesser. But however, GST has turned around the table. In fact, earlier when we used to talk on service tax or excise, the audience versus the GST. The GST has completely turned around a lot of things. So I'll just touch upon as the previous speaker, few key aspects which some changes which the government intended to make, and that will make our life sometimes miserable, but sometimes better also. Means there are some changes which the government made it now. Indication that there is some benefit in the past, or we could take some benefit in the past. So this also both ways the government makes the amendments. In fact, there are some planning which is being done using the amendment. So this amendment is made today. It is intended to do this. It means in the past, was it applicable or not? Was that a question? It means any amendment, first thing we have to test is that does it have retrospectivity by its nature? Is it a clarificatory amendment or is it a substantive amendment having a prospective effect? So in that context, just a few key amendments made. Earlier GST happens to be the thought process is ease of doing business, make it 3 days, you get the registration, etc. But then now slowly the kind of powers, the powers has been given vast to the department at this moment. Of course, we will touch upon quite a few of them also in our discussions. Okay, one of the first thing we have to do is that whenever you are having any issue with you on GST, the first thing you read is the GST Council meeting minutes. We will find a lot of supporting points for us. Okay, so that's the first thing we need to refer to. Just to touch, there was an amendment made now in this budget in the context of associations. Now we all know that association we collect membership fees. The membership fees they charge GST. That's what is the popular understanding. And if it is house welfare association means they give 7,500 rupees, some benefit is that. This is what is done. But whether it is valid in the law, first question, answer is no. The validity of the law has never told. In fact, there is no levy for a fees being collected by the association from its members. Now, was it there in the service tax law? Yes, there was a provision in the service tax law. But in GST, the association and its members are treated to be two different persons. Whether there is a supply involved or not, there has to be a supply. Underlying provision should be a supply. There was a deeming provision of supply in schedule number 2 of the GST Act. We said the association providing goods or services to its members is deemed to be a supply. But you have to understand, Schedule 2 never has powers to deem something as a supply. Schedule 2 has powers only to say whether it is a supply of goods or a supply of service. It doesn't even have powers to say it's a supply or not. So the underlying charging section for an association to pay GST was not there. So till now, if some association has not paid GST on their collections, the GST Council minutes has acknowledged the fact that there is no charging section, there is no GST on the same. In fact, service tax, you all must be aware of a very famous Supreme Court judgment in Kolkata Club where they held that association providing services to members, and also it was a club actually, it's a registered club providing services to members or any other association providing goods to its members is not liable for GST because Article 366, which is talking about the deeming sale, deeming supply, doesn't talk about incorporated associations. But Supreme Court judgment made a distinction between incorporated and unincorporated associations, and they held that unincorporated associations would fall under the deeming provision, means it's a sale of goods, the deemed sale of goods as per Article 366. Whereas the incorporated association doesn't even cover under the article constitution, so there's no power in the law itself. Service tax law doesn't have even powers to levy service tax. This was the decision of the Calcutta Court. It was delivered somewhere in 2019. Taking cognizance of this fact, the government made an amendment in this budget. So what they said is, the amendment made was not just saying that incorporated association, etc. It just said any association providing goods or services to its members or constituents. Now they have used one more word called constituents. So who is a constituent is the next question that would come in. Is deemed as two separate persons and deemed as a separate. So they brought a retrospective amendment from 1st July 2017 saying that this has to be taxed. Now whether it says any association, whether it is registered or unregistered was not mentioned. It naturally means any association. Whether this can go back and has powers to tax an association which is registered and providing goods and services to its members, because the Article 366 says that only unincorporated association is deemed as a supplier. So that means the amendment proposed now still may not have the force to levy tax on any registered associations. When I say registered, it means any incorporated associations providing goods or services to its members. So this is a resident welfare association. They are registered under the Societies Registration Act normally. Now this association collecting fees from the members, we all know 7,500 exemption is there, etc. But many people know more than 7,500 they do collect GST, they comply. Whether does it have a force? Till now, even after this amendment is made, the Supreme Court judgment holds good. Because naturally, of course, we have to test every amendment made with the conditions of the Constitution. And the first amendment they made, proposed amendment made in this section 7, where they deemed this as a supply, still may not tax the registered association. So if somebody is not paying GST on the sale, they may still have a case in hand, though there is a retrospective amendment made on 1st July 2017. Registered associations may not be covered as part of this. However, all know that it's only a proposed proposals. Since that the government has, I would not even say it's a proposal, because of course every state governments have to pass, GST Council has to recommend, etc. One of the basic underlying understanding is that GST Council has to give a recommendation for any changes to be made, and pursuant to the recommendation being made, it has to be brought as an amendment in the law by the respective executive authority. Some of the amendments which are proposed are not yet a recommendation made by a GST Council itself. Okay, that's
like saying in a love marriage, the father and mother has to be their confirmation.
Yeah.
When they have already decided.
Yeah. So it is basically like there are some amendments made. Even the fact that the GST audit, which is proposed to be removed. Yes, there was a discussion in the GST Council meeting that was only in the context of enhancing the turnover limit. There was the proposal, the collection was very less, the amount etc. was there. But however, there was no recommendation by the GST Council to the government.
There was a recommendation.
But the recommendation was only more of enhancing the powers.
No. As a chairman of the GST committee,
Yeah.
there was a recommendation. A specific recommendation was there.
Yeah, please.
In fact, he is right in one way, because the recommendation was at the very end, after 4 pages, in the last paragraph. See, the entire discussion, as he rightly said, hovered around the extension of due date for 9 and 9C. And interim certain states, Bihar, Goa, Jharkhand, they raised objection that why at all there should be an audit. The audit is not required. And there was a charge made against auditors saying that you are not pleasing the clients. Let us not get into all those things. There was a charge made by certain state. Kerala was the only state, it is recorded in the minutes, that's all, which supported the no audit. And the last paragraph is very clearly stated that section 35 and section 44 be amended. And what is the amendment was also there as a part of an annexure. No one reads that. It just passed through. It just passed through. Please.
Okay. So now, the first amendment made on the proposal was on the association side. So that was more of the amendment made in section 7. It might not be still valid for associations having mutuality of something. That is, wherever there is a mutuality of incomes, the amendment made may not still be having the force. The Supreme Court judgment may still be valid in this regard. It's the first observation on the proposal. Proposed proposal, of course, all state governments have to get their nod. The second major one was in fact, it's a good amendment made that could also give us a tip of the iceberg. Is an amendment made to say in the section 16, there was an amendment made in section 16, where they said that this is the amendment made in section 16, where they amended the law itself. And you all aware that now GST you can take tax credit only when it is available in the form 2A, 2B, 1. There are so many different alphabets we use. Only after that we can take the credit. That's what we can. That's what the law that is given by Rule 36 of the very popular. Even somebody does not know any section number of the law. Rule 36 of Rule 4 is something which many people would have heard of. So this is a provision inserted in the rule. Now the question is, does it have the force of the law? Does it have the section? Does the rule can only prescribe what the law has empowered? Does it have the empowerment in the law? So this was also discussed, of course, in GST Council, etc. And there has already been a lot of challenge made to Rule 36 of Rule 4, saying that it is ultra vires. Now what is Rule 36? Basically it talks about documents which have to be used for taking input tax credit. What are all documents you can use? That was the entire context of Rule 36. Now, in that Rule 36, so the powers given in the rule was primarily for the documents. What are all you can use for taking the credit? In that, there was an insertion of this point, sub-rule, where they said, if you want to take the input tax credit of a particular invoice, the details of that invoice must be furnished by the supplier in this GSTR 1 in the form which is filed. Okay. Now the question is this a new condition imposed for availing the credit, or is it only a documentary requirement? That was the issue. Now we all must be aware that GSTR 2A or 2A is not a valid form as on date. It's just a statement. It's just a form for information. 2B for that fact is also an information which has been given to us. So because of this context, already there has been a challenge, and the government has also understood the fact that that is an additional condition. It is not something, a procedural form. The government is saying, I have powers to decide the form and manner in which input tax credit can be taken, can be decided by me. That powers is given. Now, imposing a new condition by way of additional GSTR1, is it covered under the form and manner of taking credit? Okay, so it is not the form. Definitely, it's not the form for taking credit. It is not the manner of taking credit. Manner of taking credit is basically how to utilize the credit, in which order and how to utilize, etc. So this Rule 36 of Rule 4 basically goes beyond the Section 16. Section 16 is the other section, which talks about conditions for taking credit. Conditions for taking credit is given in Section 16. And Section 16 talks about 4 conditions that you should have GSTR, you should have paid the tax, supplier should have paid the taxes. Those 4 conditions should have the invoice with you, etc. None of the Section 16 conditions talks about matching with your GSTR1 supplied to the supplier. The supplier uploads, and that information should be matched with us. None of the section, none of the provision talks about that point. Considering this potential weak link, the government has made an amendment through this proposed budget, where they introduce a provision as a condition in section 16. They say that the details of the invoice or debit note, which is referred in clause A, has been furnished by the supplier in the statement of outward supplies, and such details have been communicated to the recipient. So this particular provision was not there in the law. Okay. So this is the very basis on which we are now applying the 10% rule, 5% rule, etc. That was enforced through 36(4), and considering the 36(4) possibly is an ultra virus to the section itself, they've imposed this new condition in section 16. Now we need to remember from which date is it effective. Next date. The effective date has not been mentioned in this section. It means it will be notified on such date. Most likely, it cannot be, but it has to be retrospective. It's an amendment in the section. It has to be retrospective. They should have brought it from the law itself. Since it has not been expressly mentioned out in the law, this is going to be a prospective effect provision. Basically, they are intending that it will be 100% matching from next year. So, in that context, they have issued. It means, as on date, the rule 36 of rule 4 provision may not hold the test of the courts. As of now, of course, it is being challenged in so many courts. 36 of rule 4 goes beyond the provisions of section 16. Section 16 is the basic section which gives you the eligibility to take the credit. And there is no power given in the central government in section 16 to prescribe an additional condition over and above what is given in section 16 as part of the rules. You can mention documentation. You can mention the manner in which you wish to take. But however, you cannot prescribe an additional condition which could superimpose the basic eligibility to taking the credit, and that is one of the reasons where section 16(1) is section 16(2) is being amended to add this condition in the law itself. And of course, the council meeting minutes also records this point, that there could be a potential issue on this point, and then they have included. So if somebody has taken credit based on a valid invoice and not have gone based on GST or 1 or 2A or 3B, they may still have a valid case to hold on to as regards Rule 36 is concerned. Of course, we'll expect the judgments in some time. The only good thing is that they have not brought this retrospective amendment in the section. So naturally, when a favorable judgment comes in favor of the SSC, we might see a different amendment being done to this particular provision. But as it stands today, Rule 36(4) may not hold good, especially considering the fact that an amendment proposed to be made, clarifying. Of course, you cannot. Okay, next question is the government will bring out the facts that this is a clarificatory amendment made in the section just to clarify our intentions. Now, any clarificatory amendment, if it has a substantive effect on the credit eligibility of the taxpayers, cannot be considered as a clarificatory one. It has to be treated as a prospective effect only. In such cases, this provision, so if somebody has taken credit on the basis of their own invoices, physical invoices, not relying on the 1 or 2A, there's still a good chance of taking the valid credits in this. Of course, it is subject to high litigations, but this is one of the major amendments the government has proposed to make, clarifying the intentions behind this amendment, the second one. And of course, the third one, the third major amendment, DSTR 990 is removed, etc. Okay, that point is quite popular, and of course, still reconciliation statement has to be filed, that has to be self-certified by the taxpayers. So, still the role of the chartered accountant is there. No person will file it on his own. The review will be there by a chartered accountant, but definitely commercial value might alter, etc. That is
you can tell this also. I believe that even 2021 also audit will
continue, yeah.
Because till such time all the
state governments have to pass. So the point is that they are not yet notified. The section is not yet notified, and we are now in the month of February, March. Next April it will start. So all state governments have to agree. In fact, when we had interactions with some of the authorities, some state governments are not even aware that there was an amendment made to eliminate GSTR 990. Some of them, not all. So, of course, this will be a matter of debate. In fact, Tamil Nadu, we had Form WW for a very long time. So, that is something which is considered to be a dealer-friendly move. It is not treated as a dealer-contrary move as regards the policy of the government is concerned. But anyways, so as it stands today, it is still valid, even for 2021. Hopefully, that's what we can say. The next amendment or the next change they made on the they have given extraordinary powers in some of the provisions which has been debated and few other provisions has been challenged. You all must be aware there is a section which deals with interest. The interest is automatic, whereas it has gone through a lot of litigations in the past. Like for example, I issue notice for demand. The department will not quantify the interest. Now the next question is, should there be a show cause notice for interest? Law has made it, powers has been given, it can be automatically deemed to be demanded. The next question is, what if I don't pay the interest? Now, for example, there's a difference between 1 and 3. So I have declared 1 crore tax in 1. 3B I have declared only 80 lakh rupees of tax. So there's a difference of 20 lakhs tax to be paid. Now this 20 lakhs of tax which I have to pay, I have declared in a 1. In fact, many people declare the correct tax so that the customer can take the tax credit for the same. This is very real or it's an unwritten open secret is what I can say. So we declare the correct tax in 1, 3B, okay, whatever money you're having, you pay. Next month you adjust it and pay the difference. That's what typically it goes. And government has realized it now. Okay. So what they have brought an amendment is that now for that difference of 1 crore and 80 lakhs, difference 20 lakhs is there. Procedure now is that they will keep on asking you, please pay, difference notice will come, discrepancy notice will come. You don't pay means they will go for next step, etc. Now, simple, direct attachment to your bank account is empowered. Okay, so they directly can issue a recovery notice for the difference 20. Now, one important point is that should there be an opportunity of being heard to be given or not? Okay, that's the next question that comes in. This amendment was made. So this amendment was made to bring in I'll just quickly go to that amendment. This amendment has been made to say that it has been made in 7512, section 7512. Section 7512 is basically cases for recovery. They're all talking about the list of cases where you can go for recovery. The same provision is there for interest also. I was talking about interest. Why? Because for interest also, they need not go and issue a show cause notice, ask you money, etc. They can directly, powers have been given to go for recovery. In this context, there has been already so many cases where your interest was gross, late, all those issues happened. At that point in time, department went ahead and gave recovery notice to their attachments without even giving an opportunity of being heard to the taxpayers, saying that 75 never talked about opportunity of being heard. It said these differences, recovery can be initiated. Simple. That's all they have given. So the point was, in the erstwhile, when interest issue was there, recovery notices has been given without an opportunity of being heard because section never said opportunity of being heard should be given. Of course, the matter has traveled to the courts, and some of the courts have taken a view that it has to be given because that's a principle of natural justice has to be ensured. In the same provision, they have included now this amendment also. So that means if there is a difference, the powers of the officer exist for them to go for an immediate recovery procedure. Though of course, by understood legal principles, an opportunity of being heard must be given. That is an understood principle, but extraordinary powers has been now bestowed on the officers to go for a direct recovery in this matter. So of course, if you go through, we will have more litigations now to face. So one way we feel that GST or 9 and NC is there, but you will other side there are so much of opportunities which now is going to pop up on the litigation side, where such issue will be a regular issue for any dealer. Imagine a small dealer having 5 lakh rupees, 5 lakh, 4 lakh difference, 1 lakh rupees attachment. So this power has been bestowed on the officer as such. This is a very subtle amendment they made, but again very impactful amendment for a day-to-day dealer. Now this read with one more provision. We all are aware about e-waybill, all those stuff. E-waybill has to be there for all goods. When we move, e-waybill has to be there. That is understood. And now they have enhanced the kilometers from 100 to 200 kilometers. These are all fine. In fact, there is one certain amendment made in the e-waybill provisions. That was a very stringent provision, I would say. In fact, what we used to do practically, so government has basically understood ground reality. One of the example of whether government is knowing the ground reality or not. As regards GST, some of the trade practices are concerned. The government has understood the ground reality in the sense that they know what are all people were doing it. They have tried to block one by one. So what is it they have done now? The e-way bill, let's say there was, goods got moved from location A to location B, e-way bill is not there. What is the procedure normally is that officer will hold you and they will say you have to pay two things. One is interest, let's say interest is as a tax 1 lakh, penalty 1 lakh, 100% of the tax. Very few provisions where there is no power given to the officer to decide the penalty also. This is that 100% of the tax is the penalty, that's all. The officer does not have discretion up to 100% or is not there, straight 100%. In fact, all the cases it went to the high courts. They can't do anything. The high courts clearly told bank guarantee has to be given. The only place where they told is okay, there is a procedural mistake, very small mistake, we leave. Otherwise, also they told you bank guarantee for 100% of the tax and the penalty. Okay. So the point there was you pay, let's say 1 lakh tax, you pay 1 lakh rupees tax, 1 lakh rupees penalty, take the goods. And the tax portion, what they will do, okay, the dealer will say, okay, that 1 lakh rupees we will adjust against our liability in the month end. Typically, these things would have happened. The 1 lakh penalty gone. Income tax also is zero. Now, that is one side. Now, the provisions, the government has understood this point. So, the amendment made now slightly different. They said, you have to pay a penalty which is equal to 200% of the taxes. Okay. So, there is no tax paid. What we are now going to pay for every e-way mortgage is going to be only a penalty of 200% of the tax. It means, now example, outflow will be same, 2 lakhs only. Here it's also 2 lakhs, and there also 2 lakhs only. But however, as regards the adjustment is concerned, it's gone. So we are going to have a huge impact on this. There's going to be a 200% of the tax is going to be levied as a penalty. And that penalty, okay. Another issue is when we go for appeals, next provision which comes in. Normally we don't agree to the office. So simple 1, 2, 3, 4. Instead of that, if they put 1, 2, 4, 3 also, they say it's a mistake, intentionally evade, 100%. This typically you would have seen, though the government has been circular on this matter, they naturally go for 100% of the tax penalty. So what happens? We go for appeals against that order. And when you go for appeals, with a very, maybe with intentional or unintentional, government has made one provision, as they said that before. Appeals has to be, we have to pay 10% of the tax alone as pre-deposit. Balance is stayed automatically. So you pay 10% of the tax, pre-deposit is given. It is automatically stayed. So if it is 1 lakh rupees of tax, 1 lakh rupees penalty, I pay 10,000 rupees as pre-deposit, go for appeal, balance 1.9 lakhs is stayed. So absolutely kind of a comfort. In fact, there are cases where we have charged only penalty and there is no need for pre-deposit as on date. Or in fact, SQL service tax law was having a provision where they said if there is only penalty, then the penalty you have to compute the pre-deposit. But GST doesn't have the specific provisions as regards penalty is concerned. Somebody is challenging penalty, as on date there is no need to pay a pre-deposit for the same. 100% stays given if you go on appeals. Now, if the issue, okay, let's take this example. So when we come to this example, we are not going to pay only penalty. Okay, so naturally the taxpayer will say, let's go for appeals and no need to pay, just go for appeals and get the order stayed. However, there's an amendment made in pre-deposit specifically on this point where they said, if you are going for appeal against the e-way bill issue, where they said that you have to pay 200% of the taxes penalty, your pre-deposit has to be 25% of the penalty which has been levied. So it means what? On one side, they have doubled the penalty. On other side, where there was no penalty, they have now brought a deposit, they have now brought a 25% free deposit for the same. So it means a huge, imagine it's not an impact for somebody who is dealing on very rare cases, but somebody who is on a day-to-day basis movement with the dealers should be made consciously aware of this fact of a huge impact they are going to have on a day-to-day transaction on this. It's a very subtle amendment the government has made. Of course, in the speech it is worded as deterrent measures. That's all, it ends there. But imagine this gives an extraordinary set of powers at the officers level to have a kind of a penalty being levied in this regard. So this is another amendment made in the context of the penalty provisions on e-way bill, etc. This is about the detention part. In fact, earlier there was no time limit.
Amendment with respect to the e-way bill.
was actually moved by our committee only.
Oh, from
the GST and indirect taxes committee only, we moved this amendment saying that you are then collecting the tax twice. So we said that either make it penalty or you make it a appealable penalty. But if you look at India as a whole, you know, the compliance that we have in the southern region, we don't record it.
happening. So that is about 5% of the crowd, and the entire 95% of the crowd is also getting equally penalized for those situations. There are, in fact, genuine traders have been blocked credit, so that is also happening. So that is the deterrent provision should be there, but again it has to be done in a manner that it doesn't discourage the majority of the traders to do their normal businesses. So this is another impactful provision they have brought. This is the provision. Amendment is zero. So this is the amendment made. Yeah. So the next important changes which the government has made is on confiscation. There are more of procedural amendments. I don't want to go too deeper into that. One of the pertinent issue which we have is on the interest side. The interest nowadays the audit have started, and of course a lot of ineligible credits reversal has started. All those things have come up. And whenever there is a ITC reversal is being made, the interest being charged is at 24% per annum. That's the interest the department is proposing, and that 24% per annum is under section 50 subsection 3 of the GST law. First question is whether that is department typically proposes 24%. Whether 24% should apply or not has to be charged. In fact, there are few audit cases where we had applied and the department hasn't come back on those specific points. The 53 provision was in a very specific scenario. It was initiated, especially where there was a non-matching situation. That is, my 1 and 3B doesn't match, and hence I reverse the credit. Fine. The 53 doesn't even say that way. 1 and 3B doesn't match, I reverse the credit. Fine. Then the supplier called me and told, boss, you put the invoice, I will again put it in my GSTR one. So I again took the credit. That guy again didn't put the in his invoice in the GSTR one. So again there will be a reversal. Like double time reversal is happening. Only then 53 gets triggered. Okay. And this provision of 53 is linked to the sections 37, 38. 38 is especially not notified at all. 42, etc. 42 and all is not at all notified as on date about matching, reversal, etc. So whenever there is a reversal of input tax credit, and consequently there is an interest payment is happening, it cannot be at 24%. Though the department is demanding 24%, it cannot go beyond 18%. In fact, it has been challenged in one of the cases even by ourselves. But again, largely the issue is that whenever 53 gets triggered, 53 has no locus standi as of now in most of the notices issued by the department. Even if you see the department notices, they don't refer which provision are they referring to. They just say under section 50 of the act. They don't know whether it is 51 or 53 or where they are going to fit it in. So in which case, in fact, practically speaking, many of the notices being given still doesn't contain a proposal to levy penalty itself. Okay, first thing is in show cause notice, there has to be a proposal to levy penalty. Followed by there has to be an order. Now there are many cases where order is passed with penalty, whereas show cause notice doesn't contain a proposal. for the same. In fact, there is a straightaway, against the principles of natural justice, it has to be challenged. So, whenever an interest reversal is happening, 53 should not be made, and 51 alone should be made applicable, which may be taken note of. So this is some of the key amendments made as regards the GST is concerned. And last point that I will close the changes part is on the powers of the commissioner. See, Form 26 AS is there. So this is a very accepted practice that Form 26 AS 194J TDS would have been deducted, and the notice gets triggered to the taxpayer saying that, sir, from your 194J we found out that you rendered services, please pay service tax for the same. Service tax was there, and now it is continued by GST. Okay. Now, whether do they have powers to rely on an external document, which is not even belonging to the GST department, is an information. Whether they can rely on that to issue a notice to you. There has been already challenged, and there are enough judgments in the past on service tax. So you can't just like that rely on a document given in Form 26 days to issue a show cause notice or asking you to propose to tax. In fact, there are notices issued proposing to tax you. Your show cause notice is coming if you don't give a reply to your Form 26 days, which is not even valid because there is not even a document which has to be relied on by the GST officer. The same way, GST also there was a provision where what they told is the commissioner has powers to order or direct other documents to be verified for statistical purposes. It means what, for example, they can pull out the entire income tax data and see all the documents of taxpayers, Form 26 for statistics purposes. For example, this industry, they have declared 1 crore as tax in income tax. Whereas they cannot act on it. There's no power for them to act on it. Just the information they can give. Maybe they can suggest to government to modify. Now there is an amendment in the petition where they told that the commissioner has powers to direct inquiry to be done based on information which they are collecting from other sources. So that is what effectively the amendment made in section 151. So the commissioner or any officer authorized by him can now call for any information, and based on that they can act on it. For example, they got electricity records and they told them you have generated so much of electricity because they can get the information to handle it. And your average electricity consumption happens to be substantially higher in a particular month than the others. So the officer earlier can just get the information. That's all. The matter ends there. Not even officers, only any commissioner. Now, any officer authorized by the commissioner can get an access to such information, and based on that, they can take valid notice to you asking for what is the difference. Can you explain the differences and pay tax for the same? So there is again another extra power given to the officer to issue a notice based on this particular amendment. This last few amendments they have done these points. So most of the amendments made in GST is actually proposed proposal, but again some extra powers have been given to the department side or especially the officers to initiate additional actions in this regard. So these are all largely the GST amendments made. Of course, customs, considering the time, just quickly touch upon one of the amendments. Major amendment is that bill of entry has to be filed before the arrival comes. But I would like to touch upon some of the points, especially on the customs side of one of the points, is that there are a lot of these FTP provisions, like foreign trade policy provisions, like EPCG, etc., where the taxpayer may not have complied. Nowadays, notices are coming on export obligations not being met. For example, I have to meet 8 times, 6 times export obligations. So they're not being met. Notices are being issued. Now, EGFT has taken it as a conscious purpose to issue the notices to recover all those duties and taxes which was not paid earlier. So it means what they are going to pay now is going to be a countervailing duty plus customs duty, because it was a thing of the past, plus interest. Or what they are going to pay is basically service tax, especially if it happens to be, let's say, reverse charge cases, service tax, etc. Now the question that comes in is whether can I take the input tax credit of all those countervailing duty or service tax which has been paid. It was done before the amendment, but paid now. The question that comes in, of course, the answer is you cannot take input tax credit. Let's be clear, because there is no provision for taking input tax credit. However, there is a provision just been given in 143, 146, where the powers have been given to the department to grant refund of the S2I credits. So when you go to the S2I credits, in fact, we have few cases where the matter has gone in the tribunal. The department has sanctioned, not department, at the next level, the appellate authority has sanctioned refund. So wherever there are cases where now the taxpayer is paying the input related S2I credits like excise duty, etc. 142.3 empowers the department to grant refund of such credits to the taxpayers. Now, only thing is it should be otherwise eligible for input tax credit at that moment, because 142.3 says any input tax credit related to the period prior to the effective date shall be refunded as per section 11B. So long there is a payment being done now also, powers has been given to the department to grant the refund. Of course, refund is also being sanctioned in this regard. This is one major aspect which has come up in customs. The last aspect that I will contribute is more of what I would not say it's a amendment made now, but rather there is something which you may look at as one of the options to suggest or advise the clients also. The government has been bringing a lot of facilitative measures as regards customs is concerned. There are a lot of new measures which have been taken. Two key measures the government has taken is that one is about the bonded manufacturing facility the government has brought in. I'm not sure how many of us have that extent detail. The bonded manufacturing is a concept which was there earlier, but now the government has brought it in a very strong force in 2019 onwards. It has picked up really well in 2020. And the government has told that you don't have to pay any customs duty at the time of imports. You can just bring your goods freely to the location. When you are disposing the finished product, that time you pay the customs duty, but no interest has to be discharged on the same. It means if somebody is a major importer manufacturer, who is having a large imports, doing domestic manufacturing, or even for the matter exports. So this is basically a replacement. It is going to be a replacement for 100% EOU, because there are a lot of policy level changes happening towards EOU, SEs, etc. And in this context, the government has brought this bonded manufacturing facility where you can import without duty, keep it in your warehouse, don't need to pay any duty at the time of manufacturing, finish the product. When you're selling the finished product, that time you pay the customs duty which you have not paid at the time of import without interest. So it means if somebody is a major importer manufacturer, then they may have a huge working capital savings at this point, and if there is going to be a re-export, there is no duty from start to end. So basically, the government has brought this scheme to replace the existing schemes of advance authorization. It's going to be slowly phased out. Advance authorization, or it's going to be a EOU. All these have been considered to be anti-WTO agreements. So this government has brought this scheme. Somebody has been in this importer manufacturer, he may suggest this as a good measure. And in fact, government has been proactive in granting these licenses faster. So you may look at this as another point. Just want to share this, though of course it's not related to the budget topic, but then some of the points I want to cover. So on this note, I will close it for now. Too much information is not good for you.
Question and answer sessions. The questions are there, you may kindly request. Very good session, Srinivas. Yes. Covered overall basic provisions. One particular information which you also